BlackRock, other asset managers increasingly catering to this shift toward private markets. How is BlackRock trying to position itself?
That's right. Even though BlackRock is an indexing giant, they've moved increasingly towards alternative investment in the past couple of years. One cornerstone of that has been their attempt to raise this long-term private capital fund, which they're targeting $12 billion in fundraising for.
How successful have they been?
So far, as of April, they've only got $2.75 billion committed, so they've still got a long way to go before they reach that goal, but they announced their first kind of investing effort over the summer.
All right, so Bloomberg's Eric Shasker recently sat down with Mark Wiseman, BlackRock's global head of equities, on the shift. Take a listen.
Well, I think we may see companies stay private for longer as a result of the availability of that capital. As a result of the cost of being a public issuer, as a result of the some of the transparency.
That was Eric Shasker and talking about just this shift toward private, which brings me to KKR. The firm has raised more than $2 billion to invest in fast-growing tech companies as they expand beyond the mega deals for their for returns. I'm just wondering, Jason, more money for tech startups. Why?
Right. Well, as Mark Wiseman said, these people need money. KKR, among those stepping forward, say, hey, we got money. Yep. We got money. You need some money? But yeah, it's coming in at a time where WeWork is not that far in the past. It just happened in the last couple of weeks. These high-flying tech startups may or may not be a really good deal, but what we know is the investor appetite is huge. This is triple what KKR raised the last time they went out.
But why? Why aren't people concerned about what they've seen in terms of some of the recent blow-ups with WeWork? Evidently the latest, by the way, since we can't go a show without talking about WeWork.
Of course.
They're working on gaming,
right.
Online gaming now.
Well, now keep in mind the private markets, WeWork may be an outlier to some extent. That was a valuation that, as you well know, was really distorted by one single investor, SoftBank's Vision Fund. But you look at even something like Peloton, which, while it hasn't been a darling of the public markets, it's still trading well above its last private round. It had to raise billions and billions to get there. And so these private equity or growth equity type funds are more than willing to do that. You think about a General Atlantic, you think about KKR coming in, there's a lot of enthusiasm here, TPG being another example.
Yeah, and so there's really a question here of fundamentally how things are doing, which leads me to some of the risks that have been highlighted in the leveraged loan market. Barclays Chief Executive Officer Jess Daly recently commented on some troubled deals. Take a listen.
If you have a deal that's not structured properly, that has some idiosyncratic weaknesses to it, the market can be pretty punishing at the bottom end. But a couple of idiosyncratic deals, I think, have opened people's eyes that it's not a free ride right now.
Davide, how much of a concern for big banks have some of these more difficult loans been?
We've certainly seen some loans struggle to get done in the market, and these are loans used by private equity firms, usually to find buyouts. The tally stood at around $2 billion, a little over $2 billion as of mid last week. Then one deal got sold just on Friday, so we're probably closer to $1.5 billion now. This compares to a market that is $1.2 trillion in size and around $170 billion of loans that have been sold for private equity buyouts in Europe and the US this year. So it's not a huge issue, but it's worth paying attention to because in prior episodes, loans like these got hung when there was a bout of volatility among across risk assets. We haven't seen that now. If you look at equities, if you look even at junk bonds, they're all doing pretty well as returns are good for the year. So it just speaks to how some investors, particularly in the loan market where you have managers facing outflows from mutual funds and CLOs with limited appetite for risky deals, are unwilling at this time to finance some of the riskier transactions.